Hey everyone, this month I'm partnering with Questrade. They're building out some very cool investor tools, and right now they've got a great promo for In the Money listeners. I was actually just at their massive product showcase called The Dawn of Investing, and after meeting with the development team, I can tell you Questrade really is focused on building the future of investing right here in Canada. They've rolled out some real game changers, like they have completely redesigned Questrade Pro, which is now in beta testing. You can trade directly from best-in-class charts with lightning-fast execution, AI tools, and a full trader performance dashboard. The best part is that it's all free. And starting this December, you can actually trade assets like real physical gold right inside your account with Quest Metals, just like a stock. And they're the first in Canada to make cash-secured puts available in all your registered accounts except for an RESP. That's actually pretty huge. Sophisticated income-generating tools now available to everyday Canadian investors. But the one that actually really floored me was their 2026 announcement about custom indexing. You can actually take the S&P 500, dial down the weighting in one sector, dial it up in another, and buy those stocks directly. Why would you pay an ETF fee when you can essentially build your own customizable index for free? And for listeners of the podcast, you can use promo code INTHEMONEY, all one word, when you sign up for your first self-directed account and get a $50 cash reward. Or you can open a Quest Wealth Portfolios account and you'll get your first $10,000 managed for free for 1 year. Go to questrade.com, promo code INTHEMONEY. Hey everyone, welcome to a brand new episode of In the Money with Amber Canwar. On today's episode, we're talking about the only thing that has mattered for stock markets over the last couple of weeks, and that is the Federal Reserve's interest rate decision next week. I don't mean to be dramatic, but this could be the most important Fed rate decision of the year. And that's because the market now fully thinks we are going to get this rate cut in December. But we speak with Dustin Reid, who's the chief strategist at Mackenzie Investments. He heads up the fixed income portfolio. And he says after this, the Fed is done cutting rates. And if they aren't, they're on a collision course and potentially making a huge policy mistake. He's going to talk about what that means for your portfolio. On the flip side, in Canada, where the Bank of Canada has said, actually, we think we're done cutting rates, he thinks the opposite, that the bank is going to be forced to cut rates even more, and he lays it all out for us. Before we get into it, just a reminder, we've got a couple of special things coming down the pipe in December. We're going to be doing an alternative special, focusing on alternatives as an asset class with Paige Ellis as the guest host. And in December, we're going to be dropping special episodes on Friday in partnership with Scotia's Women Initiative. So don't miss all of those goodies. For now, though, let's jump into the interview with Dustin. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones. Whether that's buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James Advisors unique is their complete independence. With no proprietary product to promote, you'll benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $88 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. Dustin Reid, thank you so much for joining me on the podcast.
Great to be here. Thanks very much for having me.
You are joining us ahead of what we're going to call the most important Fed rate decision ever for the purposes of this podcast. But I don't know, you tell me, it's the last rate decision of the year. But it seems like it's that's the whole reason that stocks in particular didn't finish November in the red. Right. We got a turnaround moment, a TSN turning point, as it were, when the market decided, okay, we're going to get this rate cut in December. Does that feel like the right amount of stakes for setting up the meeting next week?
Yeah, I think so. I mean, I think the Williams comments last week or a couple of weeks ago were really important. That's what really changed the market. And there's been so much commentary from a number of Fed officials since the October meeting that was really leading towards no cut, Fed holding. And then Williams came in and kind of broke the tie, as it were, particularly even after Jefferson, Vice Chair Jefferson, had come in and effectively said nothing done.
So just to pause there, because people who don't know the inner workings of the Fed, John Williams is the New York Fed president.
Correct.
And so his word carries a little bit more weight. And so the fact that he said, mid-November, I think another rate cut is prudent. Those weren't his exact words, but that's basically what he said. Then that turned everything around for the market. But you highlighted something super important, which is the messaging out of these Fed members has been chaotic.
It has.
It has not been uniform.
That's right.
How unusual is that?
Very. I mean, for the 2 or 3 weeks after the October meeting, we're looking at 8 or 10 basis points priced out of assumingly 25 for December. And then it was creeping up a little bit. And then Williams, President Williams basically said, it's a go, right? People talk about the troika, Powell, Jefferson, and Williams, Vice Chair Jefferson and President Williams. And whatever the troika is doing, that effectively means that's what policy is going to be. So I think it's, we're at a point now where it's clear that the Fed is going to cut next week. And it's an important meeting because it's probably, in my view, the last cut of the cycle, at least for a while. They're probably going to be on an extended pause, in my opinion, because of a number of factors.
Let's talk about that because, hey, that's pretty controversial, especially if you're the president of the United States, Donald Trump, listening to this podcast. You're going to say, I don't think so, Dustin Reid. You should see who I've got coming in
That's right.
In 2026.
That's
he wants rate cuts. And the market, I'm sorry, is leaning into this idea.
That's right.
We are not done in December. So why do you say that we are?
So it's a real fight. It's a fight, I think, between where they want policy to go, almost come what may, versus what I think is the underlying fundamental data and structure. U.S. economy, I think, is doing quite well. Yes, it's K-shaped economy, but overall, it's quite constructive. Q3 is probably going to print at 4% real GDP. It's very strong. And obviously, there was a U.S. government shutdown, and that probably took a little bit away from the beginning of Q4. But I do think that we're going to continue to see the data pop back here as everybody kind of gets back to work. We've obviously been in a bit of a data, deluge and haven't really seen a ton of stuff over the last little bit. That will change. But the data is going to be weak for a bit. But once we get into Q1 next year, it's going to be pretty constructive. Inflation is not coming lower. Inflation is sticking around 3%, right? The labor market's cooler than the inflation market for sure. The labor market is clearly cooling, but the inflation side is pretty hot. And when you look at what's likely to come through in terms of additional tariff pass-through that hasn't happened yet, we're likely to see more inflation.
I'm so glad you brought up the data around the labor market. I don't study it as much as you do, but I have a real difficult time understanding what is the actual true picture, in part because we might not ever get the jobs picture for last month because of the U.S. government shutdown. And then because I spend more time in the stock world, I look at these retailers in the U.S. and a lot of them are pretty optimistic about what's going on for the holiday season. So how can we have a weakening labor market, but retailers doing well? Like, how do we reconcile that?
It's an odd time in the cycle. I totally agree. I think where we are, and this isn't necessarily my comment, but a lot of people will cite this idea of a low fire, low hire environment. So they're not necessarily firing a lot of people, but they're not hiring a lot of people either. But when there are firings, then those people are not necessarily getting replaced very quickly. So when you look at kind of like the Warren data, WARN data, which is a little more micro, or you look at some of the other indices around that, we're replacing the NFP data, it seemed to suggest that the labor market is definitely weaker. But this K-shaped economy, and for those that haven't heard that term before, it's kind of you have a bifurcated economy where you have, and it depends where you split it, maybe the top 30 or 40%-ish of the income spectrum is doing okay. or maybe better than okay, particularly the top 10 or 20%, I would say. Then maybe the bottom 40 or 50% of the income spectrum is having a more difficult time. Their wages, I would say, not only nominal wages, but real wages, haven't necessarily kept up with the price level adjustment pre and post Liberation Day tariffs. And so that's causing a real bifurcation in terms of spending. But net, where are we? You're seeing those retail numbers. You're seeing pretty strong GDP numbers. And within that, you're seeing pretty strong personal consumption numbers going forward.
So your bet is that we're done based on the data. I go back to the original concern, though. What if the data doesn't really matter for the next Fed chair?
Right.
This week, U.S. President Donald Trump hinted that he's made his decision, will be announced early 2026, and kind of implied that it's going to be a gentleman named Kevin Hassett, who's the National Economic Council director right now.
That's right.
And in a recent interview said, guess what? I think rates should be going lower.
He's been citing that for a long time. And it does look like President Trump has made his decision. And we'll see. I think President Trump said something about announcing it early in the new year. So we'll see how that goes. And obviously, whoever it is needs to be not only nominated but confirmed by the Senate. And we know where the Senate sits, but it's probably not going to be just a rubber stamp. Probably going to be some conversations around that. But I agree, this is a big risk. This is why I think that the Fed could pause from January to April, and then let's see where the data's at, and let's see if Mr. Hassett decides that the data is indeed okay enough that we're going to cut rates regardless. If the inflation numbers are looking pretty frothy, maybe there's a change of heart.
Remind me again when Jerome Powell's term is up.
May 2026.
So he's got some time.
That's right.
To still be in control.
For sure.
Of the situation. But everything you're saying suggests to me that in a worst case scenario, the U.S. could be headed for a policy mistake, which we've seen in the past.
For sure.
1970s is the most kind of common example where government and the Fed is on opposed, and ultimately monetary policy gives in to government pressures, and then inflation gets out of control.
That's right.
Do you see that setup?
It's absolutely a risk. It's absolutely a risk. If, the way I look at it, maybe to put numbers on it and then kind of explain the background. So the current Fed funds rate before this December meeting is 3.75% to 4%. It's a Fed funds range. With the 25 that presumably happens in December, that'll get lowered by 25. So the Fed funds range will move to 3.5% to 3.75%. Now, not everybody, but I would say the majority of people, and you can debate whether it's a small majority or a large majority, but a lot of people believe that 3.5% is around where what we would call R star or the nominal neutral rate is exactly. And so once you start going below R star or the neutral rate, you are in accommodative territory. And if the economic data does not justify that you need to be accommodative because the consumer is doing great, CapEx spending, exports are doing great, imports are doing great, like everything looks pretty constructive, then that's when you get into policy error territory, which is exactly what you're talking about. And that's what I'm concerned about later into, I would say, Q2 of next year.
We're going to talk about your highest conviction ideas later in the show, but at a high level, how do you reflect that in your portfolio, specifically on the fixed income side? Where could the accidents be? And where do you want to be positioned for this chance? And I say chance, I'd love to know your probability that this happens, if you can even handicap something like that.
So where you'd want to be positioned is you'd want to be short the long end of the curve, right? So prices lower, yields higher, on this concern that you need to reprice the entire nominal fixed income curve.
Which means like 30-year debt and higher, you would want to stay away from that.
That's right. You'd want to be short or stay away from 30-year debt. I mean, even 10s will probably be affected, but I would say the long end of the curve, where the liquidity is for the U.S., long end of the curve is 30s. So you'd want to be short the 30-year sector of the curve, because you'd be concerned that inflation's running out of control because rates are too low. And so your fixed income, pardon the pun, but your fixed income on a 30-year is going to get eaten away by inflation. And the biggest enemy to a fixed income portfolio generally is inflation. And so if you think inflation is a big concern going forward, you don't necessarily want to own that longer term debt. So that would be where you'd want to be positioned.
Is that how you're positioned? How do you, and I ask that because this has been a year, again, for the stock market, where if you just put earmuffs on to all the macro noise and just stayed invested, that was the right call.
Yeah.
There's always something to be really, really worried about.
For sure.
But that doesn't necessarily make you a good investor.
Mm-hmm. So I think that the fixed income market could be an issue. I wouldn't put it as my majority case yet. First of all, I would say a few things have to happen. First of all, the data has to continue to, evolve as I would expect. And so let's say that does. Okay, fine. And then Hassett has to get in and get confirmed, which he might. Okay, sure. And then he has to actually follow through on what he says, which he could, maybe. And then everybody else who gets a vote, and the Fed is a little different than the Bank of Canada. The Fed is effectively one person, one vote. And so in theory, although it rarely, if ever, happens, the chair could be outvoted. And so all those things need to happen. Now, the market may not care about anything I just said. The market might just say, oh my gosh, Mr. Hassett's coming in. He wants rates at 2.5%. I'm not going to wait for the if. I'm just going to the finish line. And so this is where markets and macro, I think, is fascinating and interesting. I might have these great ideas about how the sequencing of things work. And to your point, the market may not care whatsoever. And we're not trading events per se. Anybody, any investor, right? Asset manager, personal investor, we're not trading the events per se. We're trading what the market thinks those events are going to be and how much the market may or may not put an impact on those events. And so I think that's really, really fascinating. So I might have this great sequence of events like I just spelled out, but we could just run right to the finish line. And so I have to make a bet on, even if I'm right on all those events, will the market just leapfrog that whole thing? So I think there's a pretty good chance that the market could do that and the market could get a bit ahead of itself. And so we're thinking about that as we kind of look to tweak the portfolio going into 26.
And the market tends to do that because of something else. Mm-hmm. There's a North Star. And for equity markets, it's been earnings growth and AI, but it's been real earnings growth.
Right.
As long as profit is intact, and it is, and robust, that's all that investors in equities really want.
Right.
What could be that offsetting North Star in fixed income, do you think?
I'm not sure, because I think there's a lot of things that are driving it right now. Clearly, the Fed story is the story, and who's going to run the Fed. But if we have kind of a Goldilocks data evolution here for the next little bit, so the data is constructive, but it's not massively over the top constructive. That could be something that could be a bit of a North Star that the market could kind of hold the line on, maybe. But I am concerned that the market's going to get a bit ahead of itself here.
We did have I want to say we were watching for, okay, is this the moment? The bond market did have like a little bit of a freak out earlier this year.
Yeah, a few months ago.
Anytime that we head towards 5% on the US 10-year yield, that's when people, in your neck of the woods said, aha, I told you.
Here we go.
And then what happened? It just goes right back down to 4%. And let's have that in our mind as I ask you this next question, which is around the fiscal side. All this part of the interview, we've been talking about monetary policy, but the U.S. is also embarking on tremendous amount of fiscal stimulus in a lot of specific and nuanced ways that maybe isn't as easy to talk about as simply rate cuts and accommodative monetary policy, but they're doing a lot with like amortization, potentially direct injections into people's pockets and investment accounts. What are you watching on that front?
So I think all those things are important. I mean, we had the One Big Beautiful Bill Act, OBA, obviously that passed in the summer. And some of those things were coming in this year, 25, but a lot of those things are ahead of us still, particularly the tax cuts and the impact and the feeling of the tax cuts. So I think for middle income earners. So I think we're going to get a bit of a juice or boost from the fiscal side on income and taxes after February 2026. So that's still ahead of us. And you're right, the amortization around building new facilities, particularly manufacturing plants, it's huge, right? I think it's in 1 year you can amortize the entire amount. I mean, that's a big deal.
Which is going to lower your tax rate.
Absolutely.
Meaningfully. You can buy equipment instead of only writing off a bit over 5 years.
That's right.
Write it off in the first year. Guess what? Dramatically lower tax bill.
That's right. And obviously it helps earnings, right? But one thing I think is really, really important. I think this administration generally recognizes, even if we don't see it day to day, week to week in the press that a miss in the bond yield, a miss in the back end of the bond curve is going to be destructive for the economy and for markets. First of all, it makes credit a lot tighter for houses, cars, durable goods, whatever. But I think the other issue is that clearly the equity market is probably one of the bright spots so far of this administration. Everybody knows that if the curve moves significantly higher, valuations are going to get pressed. And so if the back end of the bond curve starts to fly away higher, that's going to be a problem.
Like the 10-year goes back to 5%. Do you see a test of that in 2026?
It's possible, particularly if Hassett goes down the policy. And the market believes that Hassett is going down the policy error avenue, right? Mm-hmm. And then that's the big deal. I would even say 30s going to 5.20 or 5.25. That would be a thing. But I think at some point here, because of all of that the back end, whether you call it 10s or 30s, let's call it 30s, is capped. And the administration would back off relatively quickly if we started to see, I don't know if I want to say bond vigilantes, because that's pretty extreme, but if we started to see the back end of the curve fly away, I suspect that you'll see the administration try and massage that a little bit and try and make sure that we don't have an equity market issue in addition to credit tightening and financial conditions tightening.
For background, because fixed income may be not as accessible of a topic for people, but when you use the term bond vigilantes, it's people who come in and bond investors who say you've gone too far when it comes to your fiscal spending. So I'm going to charge you a lot.
That's right.
And very few governments, I don't think any government has won a war with bond investors.
Yes.
Just ask Liz Truss.
That's right.
In England, who was the shortest reigning UK prime minister because her fiscal policy was a disaster.
Right.
It sent yield spiking and you just can't win, right? Because then you can't finance anything that you want to do.
That's correct.
It becomes prohibitively expensive.
Exactly, very expensive. And the bond market is in many ways the ultimate arbiter of, is your policy right or is it not, right? You can even, and we had, as you mentioned earlier, we had a little bit of a spike higher earlier this year, right? So even the bond market was keeping this administration a little bit in check. Now we'll see. Again, if on those things I talked about before, but if all those things happen and Mr. Hassett ends up being the Fed chair, and he does those types of policies and the data would suggest that that's not necessarily appropriate, we'll see another event. I mean, it's very, very likely we'll see another event. This market, this fixed income market, global fixed income bond market, I think has been very skittish since October 2022 with the UK Liz Truss moment. And, it was ready to go earlier this year. It'll be, I guarantee you it will be, if, it will be ready to go next year as well.
Let's layer in AI because we know how AI is showing up in the equity market.
Yeah.
It's a main driver of the US market in particular. I'd love to know how that shows up in fixed income because now everybody says, these tech companies are spending with cash.
Right.
Some of them aren't.
Correct.
Some of them are going and tapping the bond market. And I wonder, as these checks get bigger and bigger that they're writing, what is your outlook? How much is AI seeping into AI deals seeping into fixed income? Yeah,
it's a good point. So take Meta, for example, which I think is probably the best example. So in July, they announced a big bond offering to do a big AI CapEx spend, and the equity market cheered it. Well, fast forward 3 months to October, they basically had the same announcement, almost the same, language, and the equity market didn't like it at all. So you kind of see where the market can be a bit fickle around this. I think, and one of the reasons why I'm pretty constructive on H1 in particular growth for the U.S. next year is CapEx spending and AI CapEx spending. And it doesn't only have to be by hyperscalers. I think that everybody's trying to keep up. I talk about this a lot at with the team at the office, and I think it's a great discussion. But to take an extreme example, which I like doing in economics, so you take the top 8 hyperscalers, and they're probably going to increase their AI CapEx spend by 20 to 30% this year. Okay, fine, and that may or may not be true, but let's say it is 25%. Does that mean that everybody below the line from firm 9 and lower is doing 0? Seems unlikely. question is, what's the delta? Like, what is that number? But everyone's probably trying to catch up to a point, right? So I think that AI CapEx spend is very important. Most of the H1 growth, the first half growth of this year in the US, maybe as much as 60% was thanks to AI CapEx growth.
I mean, like underline that, because that means that AI spending was more of a driver than the US consumer, which is 70%.
That's correct.
Of the US economy.
That's right.
Like
it's a big number.
That's a really big number.
It's a big number. So the delta for 26 over 25 versus 25 over 24 may not be as big. So we may only see 20 or 30% increase over 25 in 26. But I still think it's enough to drive growth. And then when you look at what's priced for the Fed, and admittedly, they're probably going to do 25 next week, but when you look through December 2026, there's about 93 basis points price. So take 25 out for next week. So you're kind of around 60 or 65 basis points. So again, you almost need to have that Fed policy, we don't care, we're cutting rates regardless anyway, because the fundamentals, at least for the first half of the year, at least to me, stack up to be quite strong, whether you look at the growth side or whether you look at the inflation side.
If there are going to be cracks in the AI trade, I think it always is true. They start showing up in credit first because stock investors like to put up blinders and say, no, this isn't happening. And bond investors are a little bit more glass half empty type.
We are.
And so let's see. Are we seeing any cracks? Like look at Oracle's CDS. These are credit default swaps. So this is insurance that you buy in case there's a default on the debt. And Oracle has larger debt than others. They're very exposed to OpenAI, which is losing lots of money. So we don't know if OpenAI is going to be able to pay Oracle.
Right.
Like not that we don't know, but it's a risk.
Right.
And so the CDS on Oracle has exploded.
It has.
Higher.
Yeah.
But I want to know, is that in absolute terms? Is it relative? Like what cracks are we seeing and are they worrisome right now?
Yeah. So I spend a bit more time on the macro side than I do on the credit side. But from that perspective, I've seen that chart too, and it is obviously concerning. You know, when we look at high yield CDX, kind of the underlying index for high yield bonds, we've had what we would call very tight spreads for a while, kind of around 320 or 330 for a little bit, and it's come up a bit off the lows, but we're not necessarily seeing huge cracks in that market yet. And the investment grade spreads are not back to the cyclical lows or tights, as we would say, around 46 or 47 over treasuries. But at 51 basis points, it's still cyclically quite constructive. So the credit market at this point is not particularly concerned around whether it's AI CapEx spend from a an industry perspective or from an asset class perspective. I think the Oracle story, and it's clearly not my main thing, but it seems to be a little bit more idiosyncratic to Oracle as opposed to what's happening in tech or what's happening in IG or high yield.
Again, I'd love to clarify what all of this means, but when you're looking at high yield debt, riskier debt, relative to what's considered safe, which is the U.S. government debt, the spread you're talking about, anytime the spread is higher, it means, okay, we're feeling a little bit riskier,
right?
Or that this is riskier, so we need to charge more. But what you're saying is they're narrower, which means we don't feel like we need to charge that much more than government for risk-free money,
right?
Do you expect in 2026 to see more issuances? It doesn't seem like there's any plans to slow down spending. Is this an area? And I know you don't traffic in specific issues, but what can you say about in the bond market, what kind of AI opportunities there might be?
Yeah, I think we're going to see additional issuance in 2026. It seems like there's a lot of growth in this space. I mean, again, when I view it from a macro perspective, and I've been saying, I think we're in about the fourth inning of the AI CapEx spend on let's call it a regular 9-inning game, which I have to clarify now after October.
Yes.
So if we're in the fourth inning, then I think 26 is going to see pretty strong CapEx spend. And to your point a couple minutes ago, is that all going to come out of cash? I mean, already it has not come out of cash, right? We've already seen some issuance from some of the hyperscalers. So I would expect that would continue. And maybe that goes down the ladder a little bit. So it's not just the 7 or 8 big hyperscalers. We see other people issuing, to fund AI expansion. I think that's more likely than not. Is it going to necessarily change the change the overall view? No, I don't necessarily think so. But the market, has been generally very happy to have credit risk, right? With credits at the tights for most of 2025, except around Liberation Day, whether it's investment grade or high yield, it's been pretty constructive. And we've seen a few cracks in the high yield space with a few issuers, kind of subprime issuers in the U.S. And the market was a little bit concerned about that. But at this point, we've kind of rolled a lot of that back. So we probably need to see additional pressure to actually move that story forward.
You bring up, I kind of forgot about private credit for a second. That was in the news cycle.
Right.
Private credit is an area of the market that has seen huge growth over the last couple of years. And it's basically lending by institutions, non-bank, typically institutions, to companies. And with those defaults, Tricolor and First Brands, there were all concerns, again, about cracks and the underwriting standards who's exposed.
That's right.
How worried are you about that?
Yeah, and Jamie Dimon, who obviously is very well in the know and should be, given his role, said, there are cockroaches, made the cockroaches comment. And I think that also helped, fuel the fire around that. So we're moderately concerned. But we haven't been getting feedback from our sources and our contacts and people that we do investing with for private credit that seems to suggest it's a material or systemic issue. Clearly, if the U.S. economy slowed down materially, the risk of that becoming more of a systemic issue increases. But again, not to repeat, but I still think that the U.S. economy, particularly for Q1, looks pretty good. Now, the holdup on that is getting your money out of private credit is a little more tricky than regular public credit or public equities. And so there's this question of, well, have we actually seen the redemptions yet? Because you might be waiting 60 or 90 days to get that. So we're still early days, right? Because the two subprime issues we talked about were really late September, early October. So that would effectively mean that you hit the panic button right then and there and look for money. And you'd expect to get that money this month. Now we're in December or in January. So we're still in the very early innings of that. If we were to see redemption flows, then we'd be okay. This might be a bit more of a systemic issue. But at this point now, we don't see it. We don't see it as a systemic issue. Again, particularly if the U.S. economy performs as I expect it will in H1 26.
So your bottom line is U.S. economy does well in 2026. Still risk of a Fed policy mistake, and the right thing to do, and your out of consensus call is to be done cutting rates after December. Now let's find out how this all applies in Canada.
Sure.
Okay, so your out of consensus view is that the Fed is done cutting rates. The Bank of Canada has already said it's done cutting rates. For now, it's done that it can do.
Yeah.
Do you agree?
It's effectively said that. Of course, it also did say, with the usual caveat, if things change, then we would adjust accordingly. But for all purposes, yes, it has. So I disagree with that view. I think that the bank will end up cutting at least twice more before the end of the first half of 2026. So the Bank of Canada will cut twice by 25 by June of 2026.
Why?
So I think there's a few things going on here. So first of all, just to, again, put numbers around it and then kind of explain the rationale. So the bank believes, I think the bank still believes, that the neutral rate of interest in the overnight lending rate by the bank is a range between 2.25% and 3.25%. That's where the bank believes. That's the bank's academic literature. And with the most recent rate cut, it went from 2.5% to 2.25%. So the bank's sitting at the very bottom end of this range, which is neutral. Admittedly, the bottom end, but still the neutral.
Still neutral.
So it's not quite accommodative, although Governor Macklem did make some hint that there is some accommodation with the current rate. So a little bit kind of off the academics that the bank has published publicly, but okay, let's leave that aside. If we get into any trouble in this economy, the academic literature by the bank would effectively say that, although close, we're not accommodative in terms of where interest rates are. But if the economy does deteriorate, I would think that the bank would want to go into accommodative territory, which is below 2.25%. So what are the things?
Multiple cuts would actually be below 2%.
Correct.
Yeah.
So what would it take to do that? So I think there's a few things going on. First of all, I think the housing market in Canada is having a few issues. I think we're in for a rough reset year in 26. We've already had a relatively rough reset year in 25. I mean, you can kind of look at where home prices are, where supply is, all those things. I don't think it gets...
Just to underline that, we just got a read of Toronto home sales plunging 15% from last year.
Yep.
Condo sales
Yep.
plunging 22% from last year.
Yeah.
So like it's happening.
That's right. Very little is moving, whether it's new build or existing, whether it's condos or single family homes. Things aren't moving. And I don't think that's going to magically get better in the next 3 to 6 months. I think the risk is that gets worse. So there's one. Second, population growth here has effectively hit a brick wall. It's not all about immigration, but a lot of it is immigration. We were running at about 2.5 or 3% population growth here not too long ago, and we're effectively running now close to zero. When you have that happen in an economy in a relatively short period of time, it has an impact on the consumption numbers, has an impact on everything in the multiplier effect. And I'm concerned that we haven't seen the beginning of that impact yet. We had the Q3 growth numbers out of Canada a few weeks ago or last week. The headline looked great, but when you dug below the surface, it did not. Final domestic demand was negative. Household consumption was negative. Imports were down significantly. And this is a significant problem for Canada. So I think the immigration or the population growth story is a significant headwind coming for the bank and the economy for the next little bit.
Here too, the job data is complicating because I mean we'll get a read of jobs again for November, but the previous 2 months there were gangbusters.
That's right.
So where's that slowdown?
So so I was going to say, so the labor market is a bit confusing. So let's talk about the LFS data for a second. And
this is the labor force survey that comes out by Statistics Canada.
That's right, exactly. So generally the first Friday of the month, people might call that the household survey. That would be kind of the U.S. equivalent here. It'd be kind of the household survey. So a couple of strong prints above 60,000 for both of those months, September and October. But the October was mostly part-time, in fact, all part-time, and a lot of it in Ontario. And again, not to go back to baseball, but I seem to a lot. What was happening in October?
Oh, this was actually baseball, so it's not a metaphor.
Yeah. No, it really is. So what was happening in October, right? We have a huge run by the Jays, and you saw the increase in leisure and hospitality, restaurants, like all those things that people are out and having a great time, and it was a great run. And but is that going to happen next year? And I've said this on another podcast. I'm not going to say the Jays are going to do it next year or not. I hope they do. But if they don't, and things happen, right? If they don't, then that's not going to be repeated. And so that doesn't necessarily, help move the ball. It's a bit of a one-time thing. So that's one. And I would also maybe my final stamp on that. It wasn't long ago. I'm sure you'll love this. It wasn't long ago we talked about the Taylor Swift economy. Yeah. Right?
Yeah.
What about a Blue Jays economy for at least 4 or 5 weeks around October 2025? Seems reasonable, or at least doesn't seem unreasonable, right? So there's that. Now, the second thing is there's a second labor market report in Canada, which some people don't know about. And it's called the SEPH. And it's effectively the establishment survey version. So in the U.S., the U.S. jobs report is 2 reports. It's the establishment survey, kind of 100,000 jobs or whatever, 150.
That's like the non-farm.
That's right, the non-farm. Yeah. And then the household survey is the unemployment rate. So we generally get the unemployment rate version, kind of the household survey, which is the labor force survey. But the establishment survey, the SEPH data, which comes out usually 2 weeks after, is less publicly looked at. And that survey has been tanking for quarters. I wouldn't even say months.
I want to underline this. So the labor force survey, honestly, the way they do it is they just call a bunch of people with landlines and say, have you worked
in 2025?
In 2025 and say, have you worked this week?
Right.
And that's it. Yep. That's how we get big jobs pictures for this country.
Right.
Just FYI. And then this survey, the establishment survey, is based on CRA tax data.
Correct.
So it's real data, but it's lagged.
It is.
And so I think for October, correct me if I'm wrong, for October, it showed the labor force survey showed we made 60,000 jobs were created. The same time frame for the establishment survey said we lost 60,000 jobs.
That's
just
right.
to like highlight how chaotic this data is.
And those series have been diverging for a while. And you're right on. You're right on. And so, which one do you pick? What do you believe? Taking an average doesn't seem like the right thing to do. But at a minimum, it's okay. What's going on here? I am spending a little more time looking at the SEPH data because that's hard data from CRA, and I think kind of getting to what's happening beneath the surface. And I think it might be better data at this point in time. And if that data is even half true, then the bank is not done cutting rates. Kind of back to where we were before, right? If we are losing 10, 20, 30, 50,000 jobs a month, should we be accommodative? Should the bank be in accommodative territory? I would argue yes.
Which would dovetail with the housing data, right? Like jobs actually is the number one factor, the number one thing that keeps our housing market together.
Absolutely.
And with rates low at 2.25 and almost accommodative, the housing market's not doing anything with
it. Tells you something.
Is inflation an inconvenient problem for your thesis that we're going to be getting rate cuts?
So it was 3 or 4 months ago. The bank in theory focuses on headline inflation. Everyone talks about 2%, and that's not wrong, but it's the midpoint 2% of a 1% to 3% target band. So fine. But the bank had been very focused on core inflation, and particularly the two main measures, core trim and core median. And they had been kind of sticky above 3% on an annual basis for a while. When Prime Minister Carney, great interview by the way, when Prime Minister Carney got rid of the reciprocal tariffs in late August, early September, the bank at that point became a lot less concerned about core inflation remaining sticky and high. And that may or may not be the correct view, but that was their view. And that opened the door for the bank to start, recalibrate and start cutting rates again. So it did in September. Headline inflation now seems to be more of a focus than core inflation for the bank. And headline inflation is behaving. It's around 2%. And you can talk about GST stuff and a few carbon tax things, and fair enough, that's fine. But you step back, forest through the trees, what's it doing? Headline inflation is slowing. And so I don't think it's an impediment for the bank to cut rates here if it needs to going forward, and the economic outlook changes for the worse over the next 3 to 6 months.
I've got a soapbox view that it should just always be headline inflation because people can't X gas and X food. That's real. That's meaningful to real people.
100%.
One other risk for 2026 I'd love to get your views on, especially as you're concerned about the Canadian economy, is the trade risk.
Yes.
Now, Tariff Liberation Day proved to be kind of all bark, no bite. And that's an exaggeration because I know for a lot of companies, it's very real.
Right.
But for the market, they got over it.
Yeah.
So how do you see that shaking out? Because we've got a trade renegotiation with the U.S., and we've actually been benefiting from the fact that most of our trade is still under that agreement. So we haven't had to deal with the tariffs except in certain industries.
Right.
What do you think?
So 85% of our goods, Canadian goods that go to the U.S., is generally seen to be covered under the USMCA, kind of the new NAFTA, as it were. And so it's a big deal if it gets ripped up or there's a big change to it. I'm concerned that it's going to be a bit lumpy in terms of getting to a deal, but I do think it's in everyone's best interest. And I do think the U.S. administration recognizes that it's in everybody's interest to keep that going. So I do think we'll get there, and that might be a second half 2026 event, but there's going to be a lot of bravado and a lot of headline. There already are. There already is. There'll be a lot of bravado, a lot of headlines around, is this happening? Is it not? We already had from earlier this year, Trump effectively say, we don't need Canada. You remember that whole, right? And particularly ahead of the February kind of disaster for a week or two. And so that was, that's the MO. But I think when you talk to people inside the trade, right? When the Trade Department within the government, when you talk to Treasury, they don't see it that way. And clearly the governors around the U.S., I would say particularly the northern governors, are very pro keeping this going for obvious reasons. maybe a significant downdraft in economic growth in northern states if there's a significant change to USMCA. So I think it gets done because it's the right thing to do. And maybe that's a bit naive, but the road to getting there is going to cause some volatility. Does it impact equity markets per se? I mean, to your point, hasn't necessarily been a big deal. But this time, could it be different? Maybe it could. And maybe it impacts Canadian equities more than US equities.
All right, let's dip into the mailbag now. We got a couple of questions. The mailbag is brought to you by BMO ETFs. If you're a do-it-yourself investor looking to take control of your portfolio, BMO ETFs makes it easy. Whether you're exploring stock replacement strategies or you want to find ETFs that hold your favorite companies, their tools are built to help you invest smarter. Check out the ETF Compare tool, the stock replacement tool, and news and insights under the tools section at bmoetfs.com. It's perfect for analyzing your options, spotting trends, and building a portfolio that fits your goals and timeline. Okay, first question in the mailbag. I feel like I can answer this for our viewer because we've already got the answer from you, but I think the TLT might be the best contrarian trade. Does Dustin agree? This from Snarky Trader. The TLT is an ETF, the iShares 20-year, basically 20-year money.
Right.
And Dustin says,
well, I mean, I think, again, it depends on your view of, is there going to be a policy error or not, right? If there's going to be a policy error, then clearly TLT is going to go one way. And if there's not going to be a policy error in the US, it's going to go another. So I would. So
policy error, it's not a good investment.
Right.
And if you don't think there's a policy error, then yes, buy it.
That's correct.
And what do you think?
And if I can make a quick plug, we have Mackenzie has a Q, call it QTLT, which actually hedges for the currency side. So for Canadian investors, it's actually a great alternative to just TLT outright.
Okay, QTLT. We'll allow that plug. We'll allow it. I had been saving this question. I didn't ask you off the top because I knew it was in the mailbag. But Matthew wants to know about the role of de-dollarization or the decline of US dollar plays in the US and more broadly in fixed income markets. This is a big thing that people want to talk about.
It is. It's always around, and sometimes it's more in the media than at other times. So first thing I would say is people have been calling for the dollar's demise since, longer than I've been around, but since the 60s. Here we are. Right. Secondly, so maybe that goes into the second point, which is the dollar really is a cyclical currency, which sounds kind of crazy, but it also at the same time makes sense, right? Generally, the dollar does well when U.S. growth is doing well, Fed's hiking rates, all those things, right? The dollar is the cyclical currency, as are many currencies. So I would view it from that perspective. The third thing I would say is, in the world of currencies, where I spent a lot of my time before I got into fixed income proper, you need to have an alternative, right? When you buy a currency, you're generally selling another one. Mm-hmm. And when you're selling a currency, you're usually selling something to buy another, right? You're not just buying, you can't just sell an equity and put it in quote unquote cash. Currencies have to generally be in a currency, unless you're in a commodity, but then the commodity is kind of underlined generally in US dollars or something else. There is not a great alternative globally to the US dollar, right? China, while growing and being a little bit more market friendly, is clearly not free floating their currency, right? The euro is not of size. Neither is pound sterling. Canada, great, but small. Australia, same thing, right? So there's really no real viable alternative. And maybe this is part of the rise of, and I don't spend a lot of time on crypto, but clearly that's a big discussion, one of the big discussion points around crypto, right? But I don't think that this idea of the US dollar going away, people are worried about BRICS or another version of BRICS is happening anytime soon. What would cause me to change that is if I saw a lot of people pegging their currency to China or somewhere else. Mm-hmm. Or I saw a lot of people, and we're seeing a little bit of it, to be fair, pricing commodities in non-US dollar currencies.
What about the rise of gold?
Gold, to a point. There's a few things I think with gold, right? One is just central bank buying. The second I would say is, are people worried about a policy mistake, right? And third, with the Fed in particular. And third, again, for those of us that have been around a little while, Like the RBNZ really pioneered this inflation targeting idea in the early 90s.
This is the New Zealand Central Bank.
That's right. And they pegged it around 2%, which may or may not be the right level. And I think people more and more coming out of the pandemic are saying, and a lot of central banks, not to go back, a lot of central banks kind of use the same idea, 2%, give or take. I think a lot of people coming out of the pandemic are saying it's not 2%, right? Like, what is the real target here? Maybe it's 2.5, maybe it's 3. And it kind of goes back to some of the other discussions we had around the long end of the curve. If your kind of run rate, your steady run rate of inflation is now not 2%, or at least policy is not going to be adjusted over the medium to long term for 2%, and it's going to be 2.5 or 3, then you need to adjust everything higher. And from that perspective, gold and other precious metals, I would argue, you can see it's silver too, become more valuable because 2% is no more. Like 3% is 3% the new 2%. It probably is to an extent. Maybe 2.5 is the new 2.
What does that mean for your fixed income then?
Well, it means that everything in terms of term premium needs to be thought of differently, right? So 4% in 10-year treasuries that it was 5 years ago is not necessarily the same. So we need to look at other ideas, right? And so there's many, many things within fixed income like that. And in particular, there's a whole, and globally, there's a whole asset class or sub-asset class, depending on how you look at it, called linkers, which are basically inflation-protected securities, right? So in the US, it's called TIPS, Treasury Inflation-Protected Securities, right? Here, we've got this fabulous name, real return bonds. That's what the Canadian version's like. But that protects you again. That's fixed income investments that protects you against inflation.
So I didn't realize New Zealand was the one that invented the 2% target.
They got it going in the early 90s.
That's amazing.
Yeah.
Okay. And just a quick pickup, just because you said the dollar can fall. It doesn't necessarily mean it's de-dollarization. It's a cycle. From 2000 to 2008, we were in a downward cycle. You can argue from 2008 to now, it's been lumpy, but it's been an upward cycle.
Yeah.
Do you think we're on the cusp of another downward cycle?
I think a lot of it depends on the policy side. If people lose confidence in the Fed and the Fed's ability to conduct appropriate monetary policy, it will also be felt in the dollar. I think the global asset managers, large global asset managers, will be concerned about holding dollars over a cyclical or structural period of time. I think of trades in 3 buckets roughly in terms of timeline: tactical, cyclical, and structural. And if people think that the Fed is not necessarily doing quote unquote the right thing, that to me is beyond a cyclical change. That's a structural change, and we'll see dollar selling, I think, over a number of year period. We've
got a final question from Trevor about target bond funds. It's assumed that retail investors interested in bond funds are faced with a binary choice: individual bonds or bond funds. But there's another category I never hear discussed, that is target bond funds, which allow investors to buy funds of bonds that will mature in a specific year. They seem like a good idea to me. What do you think? So basically batching.
Yeah.
You can buy a bunch of 5 years at a certain credit quality.
Yes, you're when you do that, I think you're putting a lot of risk in one basket. I think it's better to have like a laddered approach in terms of having an understanding of where the curve's going to go, right? The curve can bull steepen, can bear steepen, can bull flatten, can bear flatten. It can also twist up or down. And I think when you do kind of that idea, you're putting a lot of eggs in one basket, and it could work out, but dynamics and market's so dynamic and things change very, very quickly. The idea behind some of those funds, I think, is holding them for a long period of time, but things change, facts change, economies change, people change. I would just be a little bit more, I would want to accompany that maybe with something that's a little bit more laddered and active in addition, and not only having something like that would be the way I would look at it.
Meaning you have like a ladder, it's literally not ladder, have 5 year, then 10 year, then,
sure.
Okay.
Yeah.
A more structured approach that way.
Exactly.
Okay, let's get into your pro picks, your highest conviction areas in fixed income. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's Capital Markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, these are, you're not giving specific issues, but you're giving areas of the market to look in. So you want to be long the Canadian front end, which means like a 2-year, for example, not a 10-year.
Correct.
Tell me why.
Right. So long 2-year Canadian notes. So prices higher, yields lower. And we talked about it a little bit right during the podcast, this idea that the bank is probably going to cut rate. I think the bank's going to cut rates at least twice before June of 2026. And market pricing is 0. So if there's 50 basis points or more worth of cuts that are yet to get priced in, you'll feel that maybe in the entire curve, but particularly at the front end of the curve. And 2-year notes are generally the best way to message that. So you want to be long, so prices higher and yields lower for all the reasons that we talked about: housing, population growth, the labor market, all those things that I think might be at risk here in Canada, and the bank would need to cut rates.
And the fact that, the rate cut's not priced in. So let's dovetail that with your second idea, which is to short the U.S. front end. We already know that you don't love the long end, the 30-year.
Yeah.
Why don't you want to be in 2-year notes in the U.S.?
So this is a bit more a tactical trade. I would say the Canada one's a little bit more cyclical. This one's a bit more tactical because I think once we get through the December FOMC meeting and the Fed cuts rates, the Fed's probably going to be on hold until May at least, and let's see what happens with the Fed governor and the Fed chair and all those things. But the market is pricing in Fed cuts for the first, let's call it third plus of the year through April and into May. And I think that that's quite unlikely. And if that 30 or so basis points, 20 or 30 basis points needs to get unwound, then that all other things equal, that should mean prices lower, yields higher for the 2-year note in the U.S. And so you would expect to see yields rise from that perspective.
Okay, so that's kind of your out of consensus views on rate cuts on both sides of the border showing up in these trades.
That's right.
Okay, your third one, let's try and explain it so my mom can understand. Okay. Emerging markets, FX carry.
Sure.
Love a carry trade.
Yes.
Tell me what way you want to be positioned and what this strategy could be useful for.
So carry trades are generally, you can look at them a couple different ways, but one way to look at it is to sell low yielding assets, or in many ways currencies, and buy high yielding currencies. And this often ends up in the emerging market space. And then generally, like from a very 50,000 foot macro perspective, carry is generally a quality environment where high growth or high beta assets are generally outperforming broadly. So you can kind of talk about it both ways. I think we're talking about it from a currency perspective.
I think about it like you borrow in a low interest,
borrow in yen or Swiss,
invest in the U.S.
That's right,
because you're not paying that much on the debt.
That's right,
and then you're getting more return in the U.S. and then it blows up whenever interest rates in Japan spike higher.
That's right, exactly. And so this idea around carry, and very back of the envelope, is if U.S. rates aren't moving significantly higher, and the dollar's not moving significantly higher, U.S. dollar's not moving significantly higher, then it's generally a good environment for carry. Now, I do think that we could see a little bit of a move higher on the rate side in the U.S., but I don't think it's necessarily going to be a big spike higher. But I do think that we've had a very constructive environment for carry for most of 2025. The dollar's been kind of choppy in a range. The U.S. rates have been very choppy in a range, particularly since Labor Day, since early September. And it's been very constructive for some of the high-yielding EM currencies like Brazil, Mexico, South Africa.
And is there an easy way to get access to those currencies, or you just go out and buy them?
So you could go out and buy them. You can buy funds and ETFs that have that. I mean, we have that in terms of QEBL and QEBH ETFs, which are hard currency and local currency EM local debt that have the currency exposure as well. So that's one way, and other firms offer them as well. And one thing, I spent a lot of time in the States, working in the States, and came back a number of years ago. And one of the things I noticed when I came back is that Canadian investors were not paying enough attention to emerging markets. And it's real, I think it's something that Canadian investors should really pay attention to. And one of the reasons, first of all, the asset class is very interesting in and of itself, offers good yields, and you have to understand the idiosyncratic risks and all that, fine. But in Canada, our base currency is Canadian dollars, no surprise, right? And Canadian dollar is not an emerging market currency, but but it is considered within the FX world a high beta currency. And so if, let's say, I'll just take Mexican peso because it's the most liquid EM currency. If Mexican peso is selling off for whatever reason, then most of the time the Canadian dollar is probably also selling off. And so that means that we have a little bit of a beta to having emerging market exposure, whether it's local currency debt or that. So you kind of have this natural hedge as opposed to a US dollar, which would go the other way. If you're a US investor, you buy emerging markets, it doesn't go your way, it's worth less, and you have less emerging market currency X to buy your US dollars back.
Whereas if this trade goes well, your Canadian dollars have gone up and your
that's right.
emerging market
there's a higher beta. And so I find that Canadian investors are a little bit underinvested in emerging markets. And so I like to kind of spread that message and just think about that as another way to pick up yield within any portfolio, your portfolio, whether it's institutional portfolio or a PA personal portfolio.
You got that, Mom? We'll see. Dustin, thank you so much for joining me. It's been an absolute pleasure.
Same here. Thanks for having me.
That's Dustin Reid joining me from Mackenzie Investments. Make sure you tune into our next episode. We're talking stocks again. We've got Brianne Gardner joining us at Velocity Partners. She really talks Canadian and U.S. large caps. So if you've got questions about any of that, email us at questions@inthemoneypod.com, and we'll see you on the next episode.